Today's marketplace, there is a lot of misinformation out there. In that 24-hour news cycle, there's a lot of spin to create the sensational soundbite to get that emotion going, get the headlines, grab the eyeballs so they can justify the advertising costs to their advertisers. And what we're going to do is we're going to separate the facts from fiction so you can make a well-informed decision for you and your family. Now, of course, no one has a crystal ball, but I believe you can eliminate the fear and you can eliminate the opinions that everyone is so quick to give without knowing the facts if you simply just look at the data. Now, the first objection that I hear is, I don't want to give up my great interest rate. I have a rate in the 2s or the 3s, and there's a reluctance to give up the low rate and move up. Well, of course, why would I give up a 2.5% rate and move to a 7.5% rate? But here's why. The average homeowner has $274,000 in equity in their current home right now. Now remember, this is the average homeowner. The other interesting average is the average of consumer debt. The average family household has over $96,371 in consumer debt. And what we find is that if you paid off this debt, it would be a massive relief and it would free up cash flow every month. The mortgage interest rate is not important because you use your mortgage as a tool. What you want to do is you want to use your equity to pay off the high credit, high interest debt. So your monthly outlay on, say, $96,000 in consumer debt is probably going to be somewhere between $3,000 and $5,000 a month. If we can wipe that out by selling your current home, reduce your monthly expenses, you're still going to have enough money to put down to purchase your new home and still make a difference in your total monthly cash outlay. The second objection I hear is, I'm going to wait for interest rates to come down. Well, how do you know they're going to come down? The reality is the difference may not be as much as you might think. On a $400,000 loan, and I use $400,000 because the average home sale price in America right now is $416,000. If I'm waiting for the interest rate to come down 1%, let's say from 7% to 6%, that's only saving you $250 a month. Now that may or may not sound like a lot, but the reality is that's only $3,000 a year. Look at it this way. The average rate of appreciation in America right now is 5.8%. So over the next 12 months, that is what is expected for values to rise. So on a $400,000 purchase price, that house is going to cost me $423,200 1 year from today. So what you're saying is, I don't want to buy it because I want to wait for interest rates to come down a full percent. You would rather wait and hope rates come down instead of going ahead and paying an extra $3,000, which by the way is likely tax deductible, instead of pocketing $23,000 in appreciation. Even if you subtract the $3,000 you paid on the interest, you're still coming out ahead by $20,000 by buying today instead of waiting. And even if rates do come down, you can always refinance, but at least you've locked in the price that you've paid for the home. Buy today and ride the wave of appreciation throughout the year. The third objection I hear is, I'm waiting for house prices to come down. Well, here's what's fascinating. Since 1942, home values have gone up 73 times and only declined 7 times, with one of those 7 times being neutral. So if we're going to bet against the champ of a home appreciation, you're likely not going to win. Now people will say, well, you can't sustain that kind of appreciation that we had in 2020, 21, and 2022. Well, in 2020 we had across the board of 10% appreciation. In 21 we had 19% appreciation. And in 22 we had 6% appreciation. And here in 2023 we're having about the same. Well, people will say you can't sustain that. You can't sustain that kind of growth. It has to crash. Well, here's the thing. From 1943 to 1947, home prices compounded 118%. So literally over a 5-year span, home prices compounded 118%. And then after that, they went up for 43 straight years in a row. 43 straight years in a row. So just because they compound doesn't mean that home values are not going to continue to grow. The same thing happened from 1974 to 1979, where it compounded 93%, And for the next 10 years, appreciation went up. And then in year 11, appreciation only went down by 1%. Then it was followed by another 14 years of positive appreciation. Now, people admittedly get caught up on 2007 to 2011, where we had the last time of negative appreciation, but since 2012, we've had 10 years of positive appreciation, positive gains. You're not likely to see home values drop. You're likely to see them to continue to go up. And here's why. We're still sitting at low inventory. We're down 38% from 2019 as far as inventory levels. Well, what most people forget to take into consideration is that 67% of millennials, which equals to be 72 million people, are coming into the market to buy a home. So waiting for prices to come down is not going to be a winning strategy. The demand for housing is outpacing the supply of housing. Now, if you'd like a custom-made mortgage plan for you and your family, reach out via the contact information below. And if you found this video helpful, please give it a thumbs up, share it with friends and family, and don't forget, subscribe for more mortgage insights. Until next time, happy house hunting.